Traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at a couple of slides and our disclaimers, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be long-term fundamentals or short-term themes that increase or decrease in importance over time. While I just get through a couple of these disclaimers, our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll be more than happy to answer them as we go, or at least at the end of the webinar. Okay, it's Wednesday, October 29, just after 11 a.m. in London. So let's get to it. A really busy week, obviously, of major risk events going on, especially kicking off today, of course, with the Fed and 3 of the Mag 7 earnings, as well as, of course, President Trump's visit to Asia and his meeting with President Xi of China tomorrow, plus then more Mag 7 earnings with Apple and Amazon after the US close tomorrow, as well as the ECB meeting and Bank of Japan meeting as well. So a manic, potentially manic 48 hours coming up. And possibly some conflicting signals, which may mean markets take some time to digest the sort of longer term moves that we will see in the longer term decisions that we will see. In any case, let's try and break this all down. So markets this morning at the moment, generally FX has been pretty quiet actually, so not too much to say about FX, but before we get into the meat about current themes and also then quick review and then preview of the main events coming up. Asian stocks, they were predominantly in the green following tech strength on Wall Street. Of course, we saw big strength in Nvidia with the announcement of their sort of super chips, if you like, and Nvidia rising nearly 5% on the day yesterday as it nears basically the $5 trillion now dollar market cap, which it should hit probably today. With US equity futures up as well in the green. Interesting, the $4 trillion mark for Nvidia was hit in on July 9, I think. So literally a few weeks later, and we're here again, very close to $5 trillion market cap for Nvidia. Quite incredible run, and really interesting about, yes, the speed of that move, but also then the breadth of the market with 25% of the S&P 500 represented by 5 of these Mag 7, of course, reporting, as I said, tonight after the close and then tomorrow night after the close as well. That's 25% of the S&P 500 by market cap, represented by just 5 companies. And in fact, if you took out the Mag 7 from yesterday's up move in the indices, the S&P 493 would have actually been down 0.6%. So just questions around that breadth, which we'll come to shortly as well. President Trump, he said he's had a great trip so far in Asia. Good for him, and he expects to lower fentanyl-linked tariffs on China. China is said to have made soybean purchases as well ahead of their meeting tomorrow. That is, of course, Xi and Trump in South Korea, I think. European equities marginally lower, though the FTSE is powering ahead and making record highs. The FTSE 100 in the UK. As I said, the dollar pretty quiet really, and FX has been pretty quiet recently. Although high beta FX like the Aussie dollar, Kiwi dollar, they've been doing very well this week on the back of that US-China trade optimism. And also we got a pretty hot Aussie inflation report out overnight, and that is sort of dashing hopes of an RBA cut next month. So yeah, Aussie getting a decent leg up, and just trading above 66 now, actually, Aussie dollar. Just on the themes idea, then US China. Well, as I said, President Trump Well, he's now considering to cut a punitive 20% tariff over Chinese fentanyl. As I said, exports to 10%, that would be. The rumor reported yesterday, actually confirmed by Trump himself actually this morning, and that has encouraged bulls and US stocks towards probably record highs again. I think it would be the 37th record high if we get that today of the year in the S&P 500. NASDAQ as well, then outperforming, futures up quite strongly around 0.7%. I think last time I checked, the fentanyl tariff will be one of the topics Presidents Trump and Xi will discuss tomorrow at their meeting. As I said, add to that list of NVIDIA's state-of-the-art super Blackwell chips. And then Trump in overnight comments actually said he's open to providing China with access to it as part of a trade deal in what actually would be quite a big U-turn by the President of the United States. China, in turn, it has said it has, as I said, bought the first soybean cargoes in months in return as a sweetener ahead of the meeting. So positive vibes, really, nothing but from this trip, really, and markets reacting to that for sure. Otherwise, earnings are huge this week. As I said, we've got a chart in here that we showed you a couple of weeks ago, actually at the start of earnings season, and that's probably moved slightly, improved actually. That 8.8 estimates of earnings growth has probably ticked up. IT, of course, tech, 22% earnings growth expected, whereas energy utilities lagging somewhat. We just got a chart in here with the Mag 7 versus the rest of the market, and you can just see they're outperforming now after sort of dipping slightly in August and September, underperforming the rest of the market, but then that has then kicked off, and yes, Mag 7 up around probably nearer to 20% now. Actually, this was a few days ago, actually, with the S&P as well, of course, up close to 14%, I believe now. Obviously, we get Microsoft, Alphabet, and Meta earnings out after the close today, first up. So if I just pull up a chart, first of all, let me just grab a chart for Microsoft first up. Yep, so Microsoft chart just here, you can see pretty solid performance this year, rallying over 20%, actually, and outperforming the S&P and the IT sector. Has given, well, did give back some gains through sort of summer, but that record high just at the end of July is at $555, and we're trading around 542 at the moment. Microsoft then focus obviously on strong cloud and AI momentum, obviously with Microsoft's intelligent cloud segment being key for growth. I think it grew over 20%, apologies, over 20% year on year, with Azure up around 33% in the third quarter of this year. Really showing that the company is benefiting from the enterprise shift into AI and cloud. On the sort of risk side, I guess high expectations and capacity constraints are the issues for investors going forward. They'll be watching really, and we'll be watching how Microsoft manages its heavy spending. If you remember, there's around $80 billion of infrastructure investment at the moment, so that will be interesting whether they guide as to more infrastructure investment, which will then, will that be seen as a good thing, or are they spending too much? And of course, then whether its growth can continue given signs of increasing competition and also some internal constraints. So that's Microsoft chart, pretty self-explanatory with that all-time high at $555, as I say, and you've got the blue line, the 50-day moving average at 512.52. Moving on to Google, Alphabet, even Google's parent, of course. All-time highs set last week, actually, on a number of deals announced. And yes, interesting that, well, revenue targets for Q3 were 99, just below $100 billion, and analysts expected Expect around 99.75, and that's up from 96.4 in the previous quarter, suggesting modest growth but still positive. Just before we get to the chart, which is pretty self-explanatory, as I say, yeah, key features for Google then will be growth in Google searches, services, sorry, so that's search and YouTube, and also the cloud business will be watched closely, as is how well the company monetizes some of these AI initiatives. So turning obviously these features into revenue. For Google options markets, or Alphabet, sorry, they see a move of around 6% plus or minus after in the 24 hours after the report. So just watch out for that. Just for your guide, Microsoft options see around a 4.4% move in the 24 hours following the report. So that's an interesting guide as to what expectations are. And then if we move on to, well, let's just have a look at the chart first of all. Let me just grab the chart, apologies. One second. Yeah, Alphabet chart, pretty self-explanatory, as I said. They made all-time highs last week on a couple of those deals announced. So we're in sort of blue sky territory, really. We're overbought slightly on the daily RSI. You can see above 70 there, but that didn't stop, obviously, this big break higher in sort of early September. So round numbers probably is the key here, 270 and then 280 potential. If we do carry on and they're blockbuster numbers, you've got the 50-day moving average somewhat below at 239.74. Next up is Meta. So I'll just grab the chart here. Slightly, haven't quite reached its record highs yet. Before I get to the chart, Meta done pretty well this year, up over 22% this year, as I said, outperforming the S&P, of course, and its peers in communications services. For your guide, it's the 5th biggest stock in the S&P 500. And options, they see a move of around 6.4% on the day following the upcoming report. So just watch out for quite a lot of volatility in Meta. Consensus, they point to EPS as $6.76. That's on quarterly revenues of 49.5 billion. And just sort of what to look out for then. Obviously, advertising remains critical for Meta, but margin pressures do loom. So that will be a risk. What investors are watching is heavily invested, of course, in AI, and infrastructure remains heavily reliant on advertising revenue, as I said. So those will be the key numbers, and certainly a headwind if ad spending slows, making then execution and costs obviously key. Also then tomorrow, as I said, we get Amazon and Apple. Before we look at that, let's just check the chart, of course. Which is obviously here. And you can just see we're just trading above the blue lines of the 50-day moving average at 742.04. The grey line is the 100-day moving average, that's at 733.78, so should offer some support. Otherwise, you've got the all-time high up just below 800 at 796.25. Just for your guide, if we do see downside, then a swing low from the start of this month, 6th of October, is at 690.51. That's Meta. Let's move on to Amazon then. Grab that chart. Also just slightly below record highs there. And really interesting, different kind of business, obviously consumer orientated, much more so, similar to Apple in a way, rather than sort of Meta, Alphabet, Microsoft. And was pretty much flat on the year. So vastly underperforming its Mag 7 peers and also broader S&P 500 as well. Obviously, it's still a heavyweight in the index, around 7% in the Nasdaq 100, 4% in the S&P 500. Options see around a 6% move over the upcoming print of results, so just watch out for that. EPS expectations, $1.57. That's on revenues of $177.7 billion. And just on the risks then, and what we should watch out for. Otherwise, it is generally a moderate growth outlook for Q3. I think they see growth of around 10 to 13% year on year. And really then it's about growth in advertising business and the cloud business, which is seen as positives, of course, AWS that is, and whether then those margins in AWS will be under scrutiny as, of course, competition in cloud intensifies. Finally, then we also get Apple out tomorrow after the US close. Just first of all, let's have a look at that chart. First of all, the Amazon chart, apologies. You can just see highs from September at 238.85, and then we've got the all-time high back in February at 242.52, so not far away from that. You've got support at 225 and 223. That's a 50-day and 100-day moving average, and then you got that swing low from earlier this month just above 210 at 211.03. Finally, let's grab the Apple chart. As I said, they also report after the US closed tomorrow. New highs for Apple yesterday, and just below now $270. You can see that from the chart here. Again, obviously a lot of positivity after the well-received iPhone 17 launch quite recently, although the stock does, or the company does remain plagued by really a lack of progress on the AI front. And that really explains its sort of year-to-date basis, trading fairly well, just marginally up now. Obviously, now we've made that record high. Still a big stock, of course, third largest by weight in both the S&P and the Nasdaq. Options, they see a move around 3.5% in the 24 hours after the report. And EPS for your guide consensus expects $1.76 on revenues of $101.7 billion. Just again on the risks around Apple, then obviously potential strong product and services growth will be looked at. iPhone sales, of course, always taken very importantly, along with services as well, which could be reaching a record high above $27 billion. Tariff exposure will be watched, with about $1.1 billion expected in the next quarter, I believe. And then obviously competition in China and in AI does expose Apple to some risks, of course, and that could dampen any upside potentially. Okay, moving away from Mag 7 then. We have just a quick look at last week's main data points. Important because obviously one of those was US CPI data. So let's just get to that first up. And just a chart showing you, I've got the wrong chart in there, apologies. My apologies, I've got the wrong chart in there. So just moving on from, I'll just explain US CPI data actually softer than expected, rising 0.3% month on month, 3.0% year on year. That's sort of the headline, but the core came in 0.2% and 3% month on month year on year. That core obviously is ex-food and energy. And the consensus was for actually a month on month headline reading of 0.4, so 1/10 lower, and 0.3 in the core, so 1/10 lower there. Pretty much signals a green light really for the Fed rate cut this week. Today, even though the core month on month continues to track above the 0.17% month on month rate that many economists think we need to average to bring down the annual rate of inflation down to the 2% target. In fact, if I just hopefully I can bear with me 1 second. I'll get a decent chart to show you. Just 1 second. It's worthy or worthwhile showing you this chart, if you can bear with me. Which I have here actually. So 1 second. I'm slightly annoying that. Apologies, I didn't put it in there previously. So let me just take that one out and stick that one in. And here we have the chart. So let me bring you back to this. And there you can see the chart. So you can just see the bar chart there, the blue bar charts, which is the month-on-month core number. And then you've got the black line, which is that 0.17 number, which is needed over a prolonged period of time for us to get back to 2%. So we're well above that. We've only been below that on a couple of months, which is definitely not enough. And that's why we're seeing 3% headline and core inflation. I think core goods inflation, that was modest, which is important, with weaker used car and medical prices offset by smaller rises in apparel and new vehicles. Housing inflation, which is a big number in the CPI basket, of course, that was benign, while gasoline and airline fares saw temporary spikes. The key question really is tariff effects, and they still remain muted as firms have shifted supply chains towards lower tariff countries. That has reduced cost pressures, and obviously then they have been taking on board their own price pressures as well, so shrinking margins and not letting the consumer digest those as yet. By all accounts, that is meant to be happening in the months ahead, but we will see, and that is the big uncertainty around whether we get tariff-induced price pressures going forward. Otherwise, the flip side to that really is if you think, or some economists think, that tariffs may lift prices later, of course, but they're seen as a one-off adjustment rather than a persistent inflation driver. So looking ahead, really, the picture is sort of still uncertain. We will probably have easing energy costs, slower housing rents, which is a big portion of the basket, around a third of the CPI basket, and then also a cooling job market that should reinforce disinflation through next year. And of course, with the labour market softening, the Fed's focus is shifting away, obviously, from inflation towards employment risks. But then on the flip side, it's whether or how much tariff-induced price pressures, of course, we do get, as I said. So that's inflation in the US. UK also had some UK inflation data, which is here. Good news there, really, for consumers at least, as the numbers surprised significantly to the downside in the UK. So headline, that came in at 3.8 versus a consensus 4%, and the core at 3.5% versus consensus 3.7%. And then in the importance services figure, that came in at 4.7, down from the 4.9%. So you can just see those figures, the previous figures here, and then the correct figures that I just read out. So just really interesting whether now we're seeing peak inflation in the UK. Momentum, for what it's worth, that slowed across all categories, and the print was actually below the Bank of England's expectations from the latest monetary policy report in August, where it had headline actually at 4%. So now we're down to 3.8. And also interesting, of course, because we had the previous week a downside surprise to wage growth. So this all really added to expectations for rate cuts now from the Bank of England. I think there's around a 1 in 3 chance now of a rate cut next month, I think. And prices have moved higher for rate cut expectations over the coming 12 months, above 60 basis points now of rate cuts now priced in for the Bank of England going forward. Of course, there are as well, though, just to add, recent Bank of England worries on financial stability and leverage. in some parts of the system, and that might obviously play around in the background. But lower inflation might be relatively better news actually for the UK budget coming up, obviously at the end of November. That comes or would come via inflation-linked interest rate payments and expenses. But we have seen now that sterling has struggled very much this week with, well, on reports. Well, firstly, we had food inflation, which was meant to be ticking lower in one report, the BRC report yesterday out early UK time, and that is one of the hawks issues around inflation was food inflation. So that if that has peaked as well, then that is encouraging for rate cut bets. And then we also had more sort of budget news as well, with the OBR potentially, I think, rumours that they would cut growth by 0.3%, and that has hit sterling, and also then increased rate cut bets by the Bank of England going forward. If we just grab firstly the chart of cable, which has suffered over the last couple of days for sure. You can just see now a breakdown now from sort of any kind of support at 132.48. We've got a fib level at 131.40, and then this low from August at 131.41. So that might be initial support, but otherwise, if we lose that, then the halfway point of this move higher is at 129.41. So a big breakdown in sterling actually. And if we look at euro sterling as well, big break to the upside. So euro strengthening against the pound here, and you can just see, if we pull it back, that has been quite a big level, the 87 sort of 50 area, just above that as well. You can see that swing high from back in November 2023. So we're breaking above that now. So targets really are probably, yeah, 88, just above that now. And then you've got these swing highs around 88.73. And then 90 potentially is a big target for bulls in euro sterling. So interesting breakdown in the pound this week on the back of all these figures that are adding to growth, the sort of subdued, should we say, growth outlook in the UK. Okay, moving on then to this week's main events, obviously, and it's central bank heavy, of course, along with those Mag 7 earnings. First up, the Fed. So let's get to it. And just a chart with the interest rates and inflation currently will take the spotlight, of course, and a fully market's fully expecting a 25 basis point cut here. That takes the Fed funds rate down to 3.75% to 4%. Then another cut is anticipated in December, pretty much fully priced as well, around 49 basis points for the December meeting. So 25 today, 25 in December. And then it's just below a 50-50 bet for a third rate cut in succession in January at its meeting there. Obviously, the Fed weighing up sort of a cooling labor market, as I've said, against still sticky inflation. Some officials, well, they're divided really between supporting jobs or keeping pressure on prices. And then in amongst this, of course, we have all the government shutdown, which means delayed government data, which is clouding the broader economic picture. There's also some speculation about whether the Fed ends its balance sheet runoff early due to recent money market strains, though opinions differ really on whether it'll be a full stop or a gradual wind down. Markets then will be watching Fed Chair Powell's press conference really for any signals on how confident the Fed is that inflation is contained and how aggressive the rate path could become into next year. I guess it's how confident Powell is amid this sort of lack of economic data, and whether he then backs up that next rate cut in December, and also then is the pivot point for, I guess, that January rate cut. And if he is fairly confident that the labour market is cooling and he's happy that inflation is falling as well into next year, then markets would potentially move closer to fully pricing in that January rate cut, that would mean that the dollar would go lower. Otherwise, if he's less cautious, or sorry, more cautious on the picture going forward because of the lack of data, then potentially we rein in some of those rate cut bets and the dollar finds a bid. Let's just pull up the DXY chart actually, which is here. So you can just see we're tracking sideways really over the last few days, very small days, and that really signifies to us that we're going to get a big range expansion day. When you get range contraction over a period of time, then at some point you'll get range expansion. So that means a big move either to the upside or downside. Generally, it would mean in line with the long-term trend, which is lower. So interesting, we've got the 50-day and 100-day moving average. This is on the dollar index chart. They are at 98.15 and 98.10, should offer some support, as well as this trend line, which has obviously been broken. So the resistance then becomes support just around that figure, actually around 98. If we lose that, then you've got these lows, which are way below around 96.21. Otherwise, upside, we've got resistance at 99.57 and 99.51. 99.57 is a low from 2023, and then the fib level 99.51 there. And then above that, you've got the swing high from the start of August at 100.25. Okay, that is the Fed. Let's go to the Bank of Canada now. They are expected to cut rates actually today as well. There'll be the first meeting out due soon. Yeah, most economists expect a 25 basis point cut to take rates to 2.25%. Bank of Canada, they recently abandoned their forward guidance, shifting to shorter term data-driven decision making. Interestingly, the economic backdrop has been fairly mixed. So jobs growth remains strong, inflation is elevated, sentiment surveys highlight cost pressures. But then trade tensions, of course, have been front and center, especially this week with this ratcheting up of tariffs by President Trump, as well, of course, halting talks previous to that. That, of course, definitely weighed on confidence and really pushed money markets to fully price in the rate cut for this meeting. We do get the latest MPR, so the monetary policy report, and that will have updates on inflation growth and neutral rate estimates to watch out for. But interestingly, policy is already below the midpoint of the Bank of Canada's neutral range. So interesting whether we get any signs from Governor Macklem about whether we're coming towards the end of this easing cycle, or of course, if we do get possibly one more cut after today, whether he signals that is still the case. Will be interesting, of course, amid slowing trade and growth momentum. The loonie sort of did pick up strength against the dollar recently. You can see that break down lower. We've got the 50-day moving average at 138.95. We're still in this channel though, this sort of moderate ascending channel. Upside really, probably this recent high at 140.80. And as I say, downside 138.95, and then you've got this fib level around the bottom of the channel, 138, 36 or so. That is dollar CAD. Moving on finally then to also the Bank of Japan. Let's just pull up this chart, which is similar to the FOMC chart before we look at dollar yen. So you can see inflation is still relatively high, but Bank of Japan expected to keep rates unchanged at 0.5% this week. Markets only see around a 10% chance. That is despite a lot of speculation that we had over the last few weeks, actually, that the Bank of Japan is edging closer to policy normalization, basically and hiking. But then we have seen policymakers remain fairly cautious amid, of course, global headwinds and the recent political changes in Japan. They have been key, even though we've had a lot of positivity over, of course, Trump's meeting as well. But the domestic political changes are key for, at the moment, for, well, the Nikkei, of course, hitting 51,000 and above, and then the yen potentially also. Just for your guide, well, the central bank, they did surprise markets last month by announcing plans to gradually sell ETF and J-REIT holdings while maintaining a 7-2 vote. So that was fairly hawkish, really. But then, of course, we had these political shifts following Prime Minister Takaichi's leadership win, which has really added uncertainty yes, really caused, well, the yen to weaken quite substantially, as Takaichi is known as a follower of Abenomics, which means she's a fiscal and monetary dove. We shall see, but ultimately, we're not expecting to alter monetary policy direction for now by the Bank of Japan. We do get an updated outlook report, so potentially downside risks to GDP and inflation forecasts. But really, it's hints around any timing of policy normalization will be key, especially as well. There is a little bit of pressure from the dollar and then higher global yields, although at the moment we are watching those very closely. Of course, we have had the meeting, as I said, between Trump and Takaichi. What happens to dollar yen will be interesting because the White House certainly would like it lower to correct the US trade deficit with Japan. While, of course, Takaichi's presumed policies are yen negative, as I said, with pressure on the Bank of Japan, sorry, not to raise rates. So interesting here. And if we just pull up dollar yen, actually, we did get to resistance again before pulling back yesterday. We have had a little bit of intervention, verbal intervention noise, I would call it, really nothing major, but you can just see interesting double top possibly or not. We've got resistance just above 153, 153.27, and then the recent high 153.25, so that should be initial resistance, and then just pull this back. Then we've got the next minor fib level of this move lower at 154.81, and then we've got the 61.8 of this sorry about that. Just bear with me. Yeah, so we've got the 61.8 at 151.61 as initial support. We bounced off that today, encouragingly. And then below that, you've got the halfway point at 149.37. Okay, finally then the ECB meeting. And if I just pull up euro dollar, which is here, let's expand this somewhat. Could be a pretty quiet meeting actually. ECB expected to keep the depo rate at 2%, pretty much maintaining its data-dependent meeting by meeting stance. For your guide, the last meeting, well, it reaffirmed the cautious approach really, with 2026 inflation forecasts revised slightly lower to 1.7%. That prompted a mildly dovish reaction, but President Lagarde did later clarify that small changes wouldn't trigger immediate action, noting the economic risks are now more balanced. This time around, no new major data really, and the ECB likely to stay patient until December when it gets, obviously, its quarterly staff economic projections, and then that could possibly reopen the debate about rate cuts. Otherwise, pretty much Lagarde expected to say that policy is in a good place. And the first or the next rate reduction really not coming or expected until early next year. Possibly March is fully priced, I think now. Only until March actually is fully priced. Growth remains subdued, and we may get some questions around political instability in France, of course, but they'll be probably reserved for the Q&A. At the moment, ECB appears pretty comfortable and steady for now, preferring flexibility. Really as it assesses inflation trends, of course, growth softness still, and broader market conditions. So yes, that's where we are, the ECB, pretty much standing pat and sitting on its hands. Euro dollar, you can just see the 100-day moving average at 116.65, 50-day at 116.86, so acting as resistance potentially. And then you've got fairly decent support around 115.40 on euro dollar. Okay, we'll wrap it up there, 40 minutes or so. Really do appreciate you being on the call. Don't see any questions at the moment. So yeah, a really, really busy 48 hours. and we look forward to speaking to you in a couple of weeks' time to see what has happened, and we'll review what has been happening in markets, and of course look ahead to the major risk events in a couple of weeks' time. Okay, take care.